Thanks for joining us today on Market Call. I'm Morello Fernandez. David Burrows with us on the show today. He's Chairman and Chief Investment Officer at Barometer Capital Management. He'll take your questions on North American large caps, and here's how to reach us. Call us toll free at 1-855-326-6266. You can email us your questions as well. Market Call at bnnbloomberg.ca. David, thanks for joining us today.
Great to be here.
New intraday highs for the TSX today. What do you see driving investment at this point?
Look, it's been really the same themes all year long. If you look at the core sector leadership groups, it's been financials, industrials, and materials really driving the bus. And materials have been exceedingly strong. There has been, I think, continued hedging in portfolios against inflation, ultimately. Inflation is sticky. And while the Fed is now cutting rates, it probably increases the longer run chances for inflation. And you see that in the long-term Treasury bond. But really, the TSX is benefiting because our sector makeup in our market is a more inflation-oriented index.
You've noticed there isn't much of a correlation between stocks and sectors. So what does that tell you?
Well, look, the problem with market cap weighted sectors is they can become exceedingly overweight certain sectors. So when we look at the S&P is underperforming almost all global markets year to date because of a very growthy index. And some of the sectors that are really working are very small pieces of the S&P. So for instance, materials is like 3%, where in the TSX, it's a much larger piece in the teens. So, it's a market right now that is uncorrelated. It means there are haves and have-nots. It means as a portfolio manager, certainly for us, we are active managers. We have an opportunity to add value.
Okay, you mentioned that the S&P compared to other equities markets is not doing as well. Can you expand on that? What are the other markets you see stacking up right now compared to the S&P?
Sure. So from 2007 until 2024, the all-world index ex-US had almost no return. So whether you were looking at Europe, or whether you're looking at South America, or whether you're looking at Asia, Japan, 33 years of no return. But in the last 18 months, international equities are outperforming the US. And part of it has to do with the fact that, 31 or 32% of the all-world index is financials, and financials have been very, very steady. Materials is a much larger piece of the global index. There are a lot of great industrial companies. And so what's happened is international investors wound up very focused in the US because it was the only game in town. And now their currencies are doing a little better and their markets are doing better. And we're just seeing some capital rotate back to international stocks.
All right, we're going to take a quick break. We will be back with David Burrows of Barometer Capital Management to take your questions on North American large caps. Here's how to reach us. We're back in a moment. Time now for a look at past picks from David, and he joins us on the show. October 2nd, 2024 is what we're looking at. At the time, David, you chose BWX Technologies on the New York Stock Exchange. So they do nuclear components as well as fuel. It was 113.28 US at the time, up to 208.77 today. So an 84% upside and 85% total return. Is this a company you are holding on to at this point?
Yeah, look, we spent a lot of time over the last year talking about power demand. And, we're going to have to expand power production a lot, and that's not a new topic. BWX is a company that has been making small nuclear reactors and running them for the Navy since 1958. So it's a pretty proven technology. They do a lot of work with Ontario Power Generation. And we think that the nuclear sector is one that we want exposure to. So, we've talked a lot about Cameco over the last year. and BWX we brought up a couple times. Look, at this is going to be a growth sector for a long time, and I think that investors want to find different ways to participate. You can do it using the URA ETF or the NLR ETF to get a broad base of companies. But this is a sector, I think, that has a long tailwind and multiples are expanding.
Okay, good to know. Let's go to your next past pick, which was Teck Resources. Again, this was October of last year. At the time, it was $70.77. Now it's $61.50, so it is down 13% for return, down 12% total return. And they have announced that December 9th will be the day that their shareholders vote on the Anglo-American offer to merge. First of all, David, what did you think of the offer?
Well, look, I have to be honest. I think that the long-term outlook for Tech B is very, very strong on their own. If they were to merge and get this deal done, I think it probably gets better. It becomes a very important institutional name for investors around the world. I think that the disappointment over the last year was the ramp up in their QB2 mine, and that's part of the reason they're considering this deal. They will get that fixed. So I'd be a buyer of the stock here. And I think ultimately for investors, this is going to be an important copper name.
Okay, let's get to your third pick from last year, which is Uber Technologies in New York. At the time, $74.28. US up to $94.08 today, 27% upside. Total return of 27% as well. What has Uber been doing? Is this a stock that you intend to hold onto longer term?
Look, this is a story of growing cash flow. And it is going to continue to grow. Now, the analyst estimates for this upcoming year have been mixed. There have been some upgrades and some downgrades. The long run story is intact. As a firm, we have reduced our exposure to the consumer in general. The stock is behaving very well. It's been a strong performer. So I'd have no problem purchasing it, but we're focused in some other areas right now.
Okay, let me just interrupt. Why are you focusing away from consumers? What's your theory around that?
Well, a couple of things. First of all, I think that inflation is stickier than the market is picking up on. I think there are clues to that. Things that do well in an inflation-oriented environment are what's leading the market. So I think that can have an impact on the consumer. I think that the jobs data in the U.S. is weakening. And if you are a consumer who has assets, the world we're living in right now is great. If you're a consumer who is living month to month on your wages, life is getting more expensive and wages are not keeping up. So in general, when I look at the consumer sector, the breadth of the advance or the percent of stocks in the consumer sector that are performing well has been weakening steadily. And so that tells me that there isn't enough new money going into the group, or there's enough money coming out where your risk reward is really not in your favor. So obviously there are going to be better companies and worse, and Uber is one of the better ones. But I think that you could look at the gig stocks and look at Amazon, for instance. Amazon has had weakening relative strength now since January of this year, and is just hovering above the 200-day moving average. I think that's a pretty good indicator of the consumer.
All right, we have to take a quick break. David Burrows, Barometer Capital Management, taking your questions today on North American large caps. We'll line up the phone calls for when we come back. Stay tuned. Time now for new top picks from David Burrows of Barometer. We're going to start with Agnico Eagle, AEM, on the TSX, a very well-known company. David, why do you like Agnico Eagle moving forward?
Morella, we see it as our job as portfolio managers to recognize structural shifts. And almost 2 years ago, when we started putting on gold positions, I have to be honest, we were really almost apologizing to clients for talking about gold because it was such an unpopular topic. I think today, 40% of investors have a 0% weight in precious metals, and the average portfolio manager has 2%. When a bull market starts in this area, it can go on for a decade, and there will be multiple stages, and we're probably in the first one. So we can correct at any time. So you want to make sure that you own companies that are the leading companies, because mining is a really hard business. It's really easy to make mistakes. It's really easy to be disappointed. And Agnico's management team for years and years and years has just done a great job of doing what they say they're going to do. So why we like Agnico, there's a lot of people who don't own any gold. This is a great single name for somebody to own, is that they have multiple properties, all in geopolitically safe jurisdictions. They have long reserve life. They have been very, very good at managing their costs. Now, with the price of gold going up, it covers a lot of mistakes. You know, at $34.60 per ounce, you know, they're going to make a ton of cash. Sequentially, you know, they probably have a 50% year over year cash flow growth quarter. And I'm going to guess it'll come in better than that. They probably generate, you know, around $1 billion in free cash flow. Their balance sheet is in great shape. And you can expect they will continue to increase what they return to shareholders by way of share buybacks and dividend growth. So we just think this is likely something that will be in our portfolio for a long time.
Very quick question. How key is jurisdiction to these mining companies?
Well, we know that historically, when some governments see companies start to make a lot of money, they say, oh, look, this is a windfall. We want a piece of it. And so having good rule of law and protection of assets, we think is really important. We don't like to wake up to a surprise where a mine has been nationalized or where there's been a large levy imposed as a tax.
Okay, let's get to your next topic, which is Caterpillar, CAT, on the New York Stock Exchange. You're looking at something very specific under the umbrella of Caterpillar, and that is their solar turbine business. Tell me about that.
Yeah, well, look, first of all, I mean, if you think there's a mining cycle, Caterpillar is going to sell a lot of equipment. That's a given. And as companies raise more and more capital, they're going to spend more money on doing development work. Caterpillar is going to do a lot of business there. That's a given. The thing I think people are underappreciating in Caterpillar is they have a big turbine business. They're called solar turbines. They have nothing to do with the word solar, but they make natural gas turbine generators that are smaller than utility grade generators that, say, GEV or Siemens might make, but big, like 100 megawatts. And this business is going to be a big business as we're seeing these data centers get built out. They're looking for alternate and backup sources of power, and Caterpillar has a great opportunity to grow here. It's only 5% of revenue right now, but this could grow at kind of 25% a year over the next number of years, and the pricing is going to be very strong. So Caterpillar has a lot of engines for growth. Their service business is great, but the combination, I think, is set to accelerate.
Okay, let's get to your last pick, which is Cameco, which will benefit from the demand for energy, but it might take longer to get there.
Yeah, it's going to take longer to get there, but look, pricing for uranium is certainly moving higher. Cameco made great acquisition from Westinghouse when they bought a lot of Westinghouse nuclear capacity, capabilities. So again, go with the leader. This was the first of the uranium companies to break out to new highs. This is going back a couple of years ago. It's got a giant structural base. In the last bull market in the 2000s, it went up about 1,000%. And we think that there's both pricing power in uranium and volume growth. So again, this is a portfolio holding. It's not a speculative position. And it's one that I think is really going to benefit the environment that we're going to be in for the next few years.
All right, we do have to leave it there. David Burrows, thank you for joining us, sir. We'll see you again soon.
Rella, thanks for having me.
And thank you for joining us today on Market Call. We'll see you again tomorrow.